Okay, we're up to Screencast for perfectly competitive and monopsonistic, which is not the same thing as monopolistic, but similar, monopsonistic labor markets. This is perhaps the most important screencast of the unit, the screencast that you're going to see the most kinds of questions on the AP exam. All right, but before we get started, a couple of definitions. We're going to come across wage determination in this screencast, how it is that it gets determined what people earn what amount of money. So we have to be specific about what I mean by wages. I guess I have to be specific about it. So we're going to make a distinction between what are called nominal wages and what are called real wages. Now, nominal wages are your wages in name only. In other words, it's the amount of money that's printed on your paycheck. If you get a paycheck at the end of the week that says $675.80, that is your nominal wage. It's your wage not adjusted for the change of prices in the economy. In other words, it's just the simple number amount on your paycheck. Now, compare that to what we're going to call real wages. Your real wage is your nominal wage adjusted for the fact that prices change. You could think of your real wage as the actual purchasing power of your paycheck. It's what your nominal wage, can actually buy. So, simple example. Let's say that you buy Gatorade, and in year one you have a paycheck that says $1,000, and let's say that the only thing you buy is Gatorade, and it costs $1 a bottle. Let's say that in year two, your paycheck still says $1,000 and you still only buy Gatorade, but now let's say Gatorade changes price to $2 a bottle. Now notice that your nominal wage hasn't changed. You're still seeing $1,000 on your paycheck, but your real wage has changed. Because in year one, your paycheck would enable you to buy 1,000 bottles of Gatorade. And in year two, your paycheck, which looks the same, only now enables you to buy 500 bottles of Gatorade. In other words, in real terms, it's kind of like you took a 50% pay cut. You would have had the same result if the price of Gatorade never changed, but in year two, your paycheck went down to $500. So from now on, when I say the word wages, what I mean is real wages. In other words, the real purchasing power of somebody's paycheck. Okay, so with that behind us and that little distinction behind us, let's start getting to the heart of the unit. Now, what we've seen so far is that MRP is essentially the demand for a resource. That's what MRP is. Another way to think about MRP is what a firm would be willing to pay a worker. You'd only pay a worker as much as they contribute to the dollars in your cash register. You'll also remember that at least in perfect competition, MRP is equal to marginal product times the price of the product. So what that means is that if you're a worker and you want to get paid more, you have to increase your marginal product. Productivity has to go up. That's called the secular growth of real wages, which is a fancy way of saying that wages can only really rise as fast as productivity rises. Again, look at the formula. MRP is equal to marginal product times price. So unless the price of the product goes up, workers are only going to get paid more if they get more productive, which is why it's so important to get a college education, get training, etc. All right, so I'm going to take you back to our little circular flow diagram. And again, we lived in this bottom box down there, that product market box, for a number of weeks. We divided that box into 4 different market models. We called them perfect competition, monopoly, etc. Then we jumped up to this resource market box, and we're going to do kind of the same thing here, but we're not going to divide it up as distinctly. Instead of dividing the resource market up into 4 different market models, we're only going to divide it up into 2 different market models. We're going to look at the 2 extremes of what resource markets might look like. Those are called a perfectly competitive resource market or a monopsonistic resource market. And in these examples, I'm going to use labor as the prototypical example of a resource. But recognize that every time I say labor, what I really mean is just resources generally. Okay, so we're going to start out with perfectly competitive labor markets. A perfectly competitive labor market is a labor market where there are many firms that are hiring, hundreds or thousands of places that you can potentially go to work, where you have many qualified workers, hundreds or thousands of people that could theoretically do those jobs. And what we're going to see is, like, In perfect competition in the product market, where each firm was a price taker, in a perfectly competitive labor market, each firm is going to be a wage taker. In other words, they're not going to have any control over the wage that they pay. So like a perfectly competitive product market, but now firms are the buyers and we are the sellers. Again, remember, in this resource market unit, everything's kind of the opposite. And if you keep that in mind in the screencast, it's going to help you out. So what we're going to do, just like we did in perfectly competitive product markets, is divide the graphs into two graphs. The graph on the left, think of as the entire labor market for a certain type of resource, maybe hamburger flippers. Now, I use this example because as a vegetarian, my first job out of college, out of Cornell with my Ivy League diploma, was in fact as a hamburger flipper for Wendy's as a vegetarian, which was fantastic. So on the left-hand side, we have the market for hamburger flippers, and on the right-hand side, we have one individual firm, maybe one Wendy's. All right, let's start building the graph. Starting with the left-hand graph, first we're going to add in the supply of workers. And again, remember, everything's the opposite now. So that supply curve is us. In product markets, the demand curve was us. But here, the supply curve is us. We are the workers, and we supply our labor. Now, it's upward sloping because there's an opportunity cost to labor, or to working, which is essentially leisure, whatever you would be doing if you weren't working. So it's upward sloping because at low prices, at low wages, relatively few people are going to show up to work. If I offer you a penny to come and clean my house, not many people are coming to clean my house. The higher the wage I offer, the greater the supply, the more people would show up. If I offered $1,000 to clean my house, a lot more people would show up. So as the wage rises, more people are willing to work, we get an upward sloping supply curve. Now the demand curve we've already seen, that's MRP, it's a downward sloping line. That's from the business's perspective. The demand is the business's demand for workers. And it's equal to the summation of the demand schedules, the MRP schedules, of all the firms in the industry. And you'll remember why MRP is downward sloping, hopefully. All right, well, just like any supply and demand graph, if we go to where supply and demand meets, that's going to determine the equilibrium price, which is the wage, right? The price of a worker is another way of saying their wage, and the equilibrium quantity of workers in that market. So maybe the wage is $10 and the quantity of workers is 1,000 hamburger flippers in this market. Now let's take a look at one individual Wendy's. Each firm is a wage taker. They have to pay the market wage. If you're Wendy's and around you there's hundreds of other fast food places and they're all paying their hamburger flippers $10, you're not going to get away with paying $9 for a hamburger flipper, right? If you offer $9, workers are just going to go to one of these other hundreds or thousands of places, a dynamic similar to perfectly competitive product markets. So each individual firm takes that wage becomes their price, what they have to pay a worker. And more importantly for us, that price becomes marginal resource cost. For a perfectly competitive firm, a firm that's operating in a perfectly competitive labor market, MRC is going to be constant and equal to the market wage, because each additional worker is going to cost you $10 additional to hire. Now, if we add in Wendy's demand, their MRP curve for workers, which again is downward sloping, we can figure out how many workers Wendy's should hire. The rule is hire workers as long as their MRP is greater than or equal to their MRC. Well, if you do that, you would wind up going right there. That would determine the quantity of workers one Wendy's would hire, maybe 10 hamburger flippers. All right, what about monopsonies? A monopsony is a case where there's only one firm that's hiring. Now, there aren't that many situations like this, but you can think of a few. If you are a nurse in Rochester, Minnesota, you're probably working at the Mayo Clinic. If you're an astronaut, you are probably working for NASA. If you are a professional quarterback, you are probably working for the NFL. Those all might be examples of monopsonies, places or industries where there's only one place you can go to work, essentially. Commonly on the East Coast or even in northern Minnesota, those small coal mining towns that essentially just have one gigantic coal mine in those towns. Those are monopsonies. If you're a coal miner, you are working at that coal mine, or you're pretty much not working in that town. So a monopsony is when there's only one firm hiring, where workers are relatively immobile. They don't tend to move around, which kind of makes it more of a monopsony. And I've noticed this, especially in Minnesota. I see students apply to colleges, they go off to college, usually within a couple of states of here, and then they wind up moving back to a dyno. I've never quite understood exactly why that happens, but just so you know, from my experience, there's like a 98% of probability that you're going to die within like 4 square miles of the spot that you're watching the screencast. Sorry to tell you that. All right, what we're going to see is that in monopsonies, firms are wage makers. Like monopolies in the product market, they get to determine the wage that they charge. So like a monopolistic product market, monopsonies are where firms have power, but again, now everything's flipped. The firm is the buyer, and we are still the sellers of the resource. All right, so to start building the graph for monopsonies, let's again take a look at the graph for perfectly competitive labor markets. And a lot of this should seem familiar to you from product markets. Instead of dividing the graphs into two, we're only going to be looking at one graph. A monopsonistic labor market might be, again, the market for astronauts, right? And maybe the hiring firm is NASA. Well, if NASA is the only place you can go, we don't really need two graphs. NASA is the market for labor. So we're going to just look at one graph. There's no really distinction between the industry and the firm anymore. NASA is the industry. And they get all of the supply of labor. This entire supply curve now belongs to them, because if you want to work for NASA, or if you want to work as an astronaut, you have to go work for NASA. So the supply of workers, again, that's us. And again, it's upward sloping because of the opportunity cost of working. The demand curve, MRP, is downward sloping because MRP drops for reasons that we've seen. Now the big little distinction here is what MRC looks like. MRC lies above the supply curve in monopsonistic market. And I'm going to give you an option here. You can simply memorize this to be the case and memorize what the graph looks like. But for those of you who are interested in understanding why, I'm going to show you. If you're not interested, you can fast forward a little bit. Let's say that we have different quantities of workers that we could hire. 0, 1, 2, 3, 4 workers. We're facing an upward sloping supply curve, which means that if we want more workers, we have to offer a higher price, a higher wage. So as the wage goes up, more people show up to work. Those first two columns are essentially the supply schedule. Various possible prices, various quantities of workers supplied. Now notice that when we figure out marginal resource cost, these numbers look different than these numbers. The marginal resource cost of the first worker is $5. The marginal resource cost of 2 workers would be $15 because 2 times $10 is 20 bucks, which is 15 more dollars than it costs to hire 1 worker. Marginal resource cost of the third worker is 25. Again, notice that these numbers are higher than these numbers. And when you plot that out, it's going to make the MRC curve lie above the supply curve. In other words, because these firms have to raise the wage in order to attract more workers, and because they have to raise the wage for everyone that they're hiring, marginal resource cost rises faster than the wage rate. All right, so going back to the graph, MRC lies above the supply curve. The rule for employing resources is to keep on hiring as long as MRP is greater than or equal to MRC. And if you did that in this graph, you would wind up right there. Here's where MRP is equal to MRC. You want to hire all of these workers. The amount they're bringing in is greater than what it's costing to hire them. That's going to determine Q star, the quantity of workers that get hired. Now, monopsonies are evil, just like monopolies are evil. In order to determine the wage rate or the price of the workers, what they're going to do is go down to the supply curve to determine the wage. They know they want a certain quantity of workers, and they want to pay those workers as little as they can in order to get that quantity. Well, that's what the supply curve tells them. It tells them that if they want 900 workers, they have to pay a price or a wage of $8. They could pay this nice high wage if they wanted to, but they don't want to. They're profit maximizing evil bastards, and they're going to pay the lowest wage they can in order to get that quantity. Now, if you compare that to what it would have looked like in a perfectly competitive labor market, you can see why monopsonies are kind of evil. They wind up paying a smaller wage, and they wind up hiring fewer workers in their quest to maximize profits. If we left it up to perfect competition, we'd simply go to where supply was equal to demand. But we're not. Monopsonies are evil. They hire fewer workers. They pay them less. All right, so the upshot here, monopsonists maximize profits by hiring a smaller number of workers and paying them a lower wage than would exist in a perfectly competitive labor market. Really important in this screencast to understand how perfectly competitive labor market graphs work and how monopsony graphs work. Now, one application of these graphs is that it allows you to understand some policy issues in a way that you might not have understood them before. Take, for example, the minimum wage. We've discussed the minimum wage before when we discussed price floors way back when, I think in unit number 2. We saw that like all price floors, it caused a surplus of workers, too many job seekers compared to the number of jobs available. Price floors tend to cause surpluses. So what we saw initially, at least, was that there's a trade-off to the minimum wage. If you had a job and you kept your job, you got paid more, but we got fewer jobs. Well, that was kind of a simplistic vision of what the minimum wage looks like, or the effects of what the minimum wage are. Now that we can distinguish between different kinds of labor markets, we can get a little bit more precise about what the arguments for the minimum wage might be. So let's take a look at a perfectly competitive labor market. This is that left-hand graph in the perfectly competitive labor market graphs. If we let the market work, we'll get a certain equilibrium price and a certain equilibrium quantity of workers. Now the government might decide that that price, that wage, is too low. People can't live on that wage. So they pass a minimum wage, something that might look like this. If you follow that minimum wage along, here's the quantity of workers demanded, how many workers businesses want to hire. This would be the quantity of workers supplied, how many people want to work at that wage. And again, the difference between those two is that surplus of workers. And what we saw with the minimum wage is that, yep, the wage goes up, but again, that's terrible. We are always limited by the smaller quantity. It's not what I wanted to show. That's what I want to show. So when we pass a minimum wage in a perfectly competitive labor market, the wage goes up, but we lose some amount of jobs. And so we said that there's a trade-off there. And if you are against the minimum wage, I think you can be against the minimum wage for altruistic reasons, right? You don't want to see jobs being lost. But what if we were dealing with a monopsonistic labor market? Again, in a monopsony, we go to where MRP is equal to MRC, which is there. That's the quantity of workers. We go down to the supply curve to determine the wage. If a minimum wage law got passed here, it might look like something like this, right? A wage higher than the going market wage. Now, if that was the case, that minimum wage would actually become marginal resource cost, right? Because now the government is saying you have to pay everyone this wage. And so for every worker you hire, your costs are going to be a constant additional cost, maybe $10 additionally for every worker you hire. You can't move along your supply curve anymore, essentially. So this firm is going to go where MRP is equal to MRC. And notice that that happens here at an even higher quantity. So if we're dealing with a monopsonistic labor market, a minimum wage looks like a pure win for workers. Not only does the wage go up, but in here we actually get a higher quantity of workers. We actually get more jobs. So is the minimum wage good for workers? Well, the answer is really it depends. It's not as simplistic as we saw initially. It kind of depends on what kind of labor market we're talking about. In perfectly competitive labor markets, there seems to be a trade-off, and in monopsonistic markets, it seems to be a pure win. All right, that was a pretty dense one. Yep.
Honey, or let's go play.
I don't feel like it.
Why are you always in such a bad mood?
I have a nail in my anus.
Oh.